Thanks to everyone who's been sending in their well wishes. We're all safe in the UAE, and thank goodness that we have the abilities that we got as a country and as a unit. So everyone is okay. But we're not here to talk about that. We're here to talk about implications in the gas market, in the oil market, shipping, what's happening, Strait of Hormuz closed, gas locked in, crude locked in, jet fuel locked in. It's been quite the week, and it's been quite the volatile week. What we're going to do, we're going to start with gas. We're going to move on to crude oil and products. I'm going to have a chat with Amina as well, just on what might happen regarding policy, what might happen regarding production. Lots and lots to cover. So we've got 90 minutes. I encourage as many of you as possible to get your questions in as and when you need to. I'll first introduce our brilliant gas team. So that's Laura, that's Go, and that's Ronald. They will get going. I'm going to share my screen so that we've got everything we have, and then we're going to go from there. All right, Laura, I'll let you introduce yourself. You can take over.
Yeah, thanks, Matt, and hello to everyone on the line. My name is Laura Page, and I lead Kepler's team of analysts that are forecasting and writing research on global gas and, of course, LNG supply and demand dynamics. And it's safe to say we've had a really busy few days on the desk, of course, monitoring the ongoing situation in the Middle East. If you are a client of our research offering, we really hope you found all of the content that we've been writing really insightful so far. So, as Matt said, in the first half of this webinar, we're going to be talking about the impact of the Middle East crisis on global gas markets. And this impact has been really significant so far, with about 20% of global LNG supplies currently shut in. And we also have the world's largest LNG plant in Qatar now completely shut down. This has resulted in a really sharp spike in gas prices. If you've been watching those, they're up currently by about 65% in Europe and Asia since last Friday. This is the highest level of gas prices that we've seen since about March of 2023. So today we're going to be discussing what's happening right now with LNG exports and transit in the region, who is most impacted by this crisis, and how those countries are going to manage this really sudden loss in supply. We're also going to be talking about a slightly different angle, and this is the impact on Egypt, who are now not getting Israeli pipeline gas supply of course, due to the shutdown of Israeli gas fields there. So we have lots of things that we want to discuss over the next 45 minutes or so. So if we go on to the next slide, we're going to first start taking a look at the region, and we're going to look at what LNG infrastructure is located in the region. Now, the key infrastructure is really on the liquefaction side. We have the world's largest LNG plant in Qatar, located within the Persian Gulf. This is as well as a smaller plant called Das Island in the UAE. Now, together, these two plants account for 20% of global LNG supplies, with Qatar being the second largest LNG exporter in the world last year, after the US, as you can see from the chart on the right-hand side. Of course, Qatar is now shut down after drone attacks and is issuing force majeure notices to its buyers. We've written lots of news stories about what's happening on the ground there, so you can keep an eye on those news stories and all of the content coming out from Kepler Insight. But we haven't yet witnessed any disruption to exports at Das Island. We saw a vessel loading there just a few days ago. So this is something we are monitoring very closely at Kepler. So that's kind of what we're seeing on the liquefaction side. If we move to the next slide, there's also LNG infrastructure related around regasification infrastructure. This is primarily located in Kuwait, Bahrain, and the UAE. In general, we think there's less of an impact on the LNG import side right now, because LNG demand is typically quite weak during this time of year, as you can see from the arrows that I've placed on the chart. Why is demand weak during this time of year? Well, this is because we are outside of the peak summer cooling season when power sector gas demand typically ramps up due to the hot weather. What you can also see from the chart as well is that this region relies quite heavily on Qatar, of course, located within the region for about two-thirds of its LNG supply. So these countries are really a bit less exposed to international supply. And in fact, we currently don't see any vessels outside or east of the Hormuz signaling for these countries right now. So that's it on the infrastructure side. If we take a look at the next slide, we're now going to take a look at what's happening with actual LNG transit. And you can see from the map on the left-hand side that this is completely ground to a halt now. That's been the case since about Saturday afternoon, London time. We're monitoring this really closely at Kepler. You know, we can see all of the vessels live on the platform, and we have a build-up of about 25 ballast vessels to the southeast of the Gulf of Oman, obviously waiting to get into the region. You can see just some of those vessels on the map on the left-hand side. These are mostly trying to get to Qatar, of course. We also have some laden vessels from Qatar and the UAE on the west of the Strait of Hormuz. Of course, these are trying to get out into international waters to meet end user demand. One thing that is notable, which I've shown on the right-hand side map, is that we have two confirmed ballast vessels moving away from the Gulf of Oman. These were declaring to go to Dubai, a shipyard in Dubai. These are Nigerian LNG vessels, and they've now they're kind of shifting focus away from the region. We are also monitoring about 9 other ballast vessels that are potentially moving away from the region. Quite hard to say whether they're just kind of pulling back a little bit or going to go to other locations. So this is something we are monitoring at Kepler, and of course we'll keep you posted with our news and diversion alerts as well. So if we go on to the next slide. Now, of course, because of all this disruption to LNG transit and Qatar, of course, shutting down production, we have recently revised our LNG export forecast for the Middle East. So on the left-hand side chart here, you can see the changes that we've made to our supply expectations for the region since before the crisis. And you can see it's dropped very sharply, particularly from Qatar, which is now shut down. Altogether, we've lost about 5.8 million tonnes of supply in March, bringing exports to just an expected 2.3 million tonnes in March. Of course, those exports that have taken place in the past few days are now trapped in the region. And to put that 5.8 million tonnes number into perspective, that was about 14% of our original global LNG supply expectation for the month. So it is very significant. Our assumption is that we could only see Qatar starting to return to exports towards the back end of March. Of course, if there can be safe passage through the Strait of Hormuz, which is a big unknown. We think these exports will likely start off as exports from the storage tanks while the plant restarts production. We understand that the restart process could take about 1 to 2 weeks. So certainly March exports will be acutely affected by the shutdown, and that will have a knock-on impact for April as well. And well, you may ask the question, well, can't other liquefaction plants in the world just ramp up to cover this supply loss? Well, we do think that liquefaction plants across the world will basically try and churn out more supply to benefit from this rise in spot prices. It's going to be really hard to offset such a steep supply loss. That's mainly because most of the major exporting countries like the US and like Australia, they're already operating at very high utilization rates. I've put a chart on the right-hand side here, which is showing the top 20 liquefaction plants by size. Of course, we're excluding here Ras Laffan, which is the biggest, and Das Island as well. And you can see that a large majority of these plants are operating at high utilization rates over the past 30 days. There are some that are underutilized. We've got Bonny in Nigeria, Bethioa in Algeria, Atlantic LNG as well in Trinidad. But these are all really struggling with feed gas availability issues. So it's not easy for them to just suddenly get in more gas and ramp up to 100% utilization or even above that. I've highlighted some of those plants there in green so you can see which ones have feed gas issues. So realistically, it's difficult to get a lot of additional supply out of these plants. We do have some plants that recently came online, like Australia's Darwin, that just recently restarted production. So we could get some modest growth there, but certainly we are not going to be able to replace the full 5.8 million tonnes of lost supply. And the figure is probably looking at around 2 million tonnes, we think, probably under 2 million tonnes at this moment in time. So if we go on to the next slide, here I'm going to talk about what this drop in exports is going to do to the market and who is most impacted. And the story is really significant around Asia. As you can see from the chart on the left, Asia imported over 70 million tonnes of LNG from Qatar and the UAE last year. As you can see from the chart on the right, China and India are by far the largest importers. They imported 20.2 million tonnes and 14.6 million tonnes last year, so very significant. We also have South Korea and Japan next in line with about 7.4 and 4.1 million tonnes. So we're really looking at kind of Northeast Asia and India in terms of where this volume goes to. However, it's also really important that we look at dependencies on Qatari LNG and countries' diversity of LNG supply as well. Whilst we do have countries to the right, like Japan and South Korea, which have quite diversified LNG portfolios and they rely less heavily on Qatar, as you can see in the bars, there are some countries in South Asia that are very heavily reliant on Qatari LNG. In particular, the one to notice is on the far left, which is Pakistan. Pakistan's reliance is nearly 100%, making it very exposed to supply risks at the moment. And I'll soon be passing over to my colleague, Go, who heads up all of our Asian analysis, and he's going to talk about how these countries could manage these supply risks going forward. But before I pass over to Go, just one last slide, if we can move over, which is a point that I wanted to raise about Asia's heavy reliance on Qatari LNG. And we are monitoring this very closely through our data team because we are now starting to see diversions of LNG cargoes taking place. So they're shifting from a Europe destination to an Asian destination. Lots that we're watching at the moment. We have 3 confirmed so far, but there's a number that are kind of on our watch list, and we report about those as and when we get the confirmation. But so far we've seen 3 vessels switch from a Europe destination to an Asia destination. That equates to about 0.2 million tonnes of LNG. And later on we're going to talk to Ron, who's going to talk about what impact this could have on Europe's supply as well. So that's it from me. I've done enough talking. I'm now going to pass over to my colleague Go. He's our expert on Asian analysis at Kepler, and he's going to talk about how all of these countries in Asia are going to get by without this Qatari LNG. So over
Right.
to you, Go.
Thanks, Lord. Go. Just before you start, mate, just a quick one. Remember to get your questions in. We've got a lot of questions that are already coming in. There's some we can answer. There's some we can't. The question around what does Donald Trump do next? I don't think anyone's got the answer to that question, so I can't dare even go down that route. The question around Strait of Hormuz, there was a very good question around. We've heard that there are 4, or someone has heard that there are 4 LNG vessels that have been escorted round the Strait of Hormuz. We can't confirm that at the moment. But keep getting your questions in. We will have time at the end to make it a bit more dynamic if you guys want. But go, I'll pass over to you now, mate.
Yeah, thanks, Matt. Let's go to the next slide, please. Yeah. Again, thanks, Laura. Thanks, Matt. This is Go Katayama, principal analyst in LNG, covering Asian LNG markets. I'm based in Tokyo, Japan. I have about 4 slides covering about 10 minutes, talking about how the demand will respond to the supply shock that we're feeling from Strait of Hormuz. So the first slide is basically a big picture. Let me start with that, take you through what we're seeing fundamentally. We think Asia is particularly exposed to the Hormuz risk. Again, Laura mentioned that 80 to 90% of Qatari LNG exports are ultimately flowing to the Asian side of the world. In the very near term, disruption that we're seeing would primarily create physical supply constraints, particularly in the markets that are heavily dependent on Qatari cargoes, spot and term, with limited storage buffers. In our base case of the 2 to 3 week supply disruption, the market adjustment would likely occur and through these like 3 regional demand channels in Asia. First of all, South Asia, which is highly dependent on Qatari supply and very price sensitive, would absorb most of the adjustment through demand destruction. And this is particularly the case for countries like Pakistan and Bangladesh. With India, also has very large imports, reducing demand across some sectors selectively. The second batch of Southeast Asia would likely respond by delaying spot cargoes through their tenders or switching fuels in their power sector. So a little bit more flexibility than South Asia to handle the shock, particularly where countries have coal or oil alternatives. And the third batch is Northeast Asia. That's the countries like Japan, Korea, and China would, in our opinion, remain relatively insulated from the physical shortages in the near term due to the high inventories and diversified supply portfolios. Although these countries will still face the higher LNG prices that we're facing in the spot market, but their affordability, their threshold to be able to pay higher prices is much higher than the South Asian countries that we see. Sort of the threshold that we mapped out in the second chart in the middle there. So the key takeaway for the big picture is that the short-term impact is a Hormuz-led disruption that we're going to see in the near term of less supply. And other production, as Laura mentioned, from other parts of the world, will try to ramp up, but there's a very limited amount of marginal supply being added at the moment. So Atlantic cargoes, mainly from the U.S., Northwest Africa, will have to divert to Asia, as we're already seeing a few cargoes start to do that. Pushing spot Asian prices higher. And then that becomes an affordability issue for these South Asian countries, leading to demand destruction, in our view, because there's a lot of supply coming out of the Hormuz that's being taken off the market in the short term. So on top of that, in addition, we're already seeing the spike in LNG prices over the past few days. Before the crisis, we were estimating about a $10 per MMBTU spot Asian LNG price, but that's sort of out the window. And we're now seeing a world with much higher LNG. And the price-sensitive markets tend to be less opportunistic buyers above $10 threshold. So we may start to see this demand destruction, not only from the short-term physical standpoint of the blockage of the Hormuz, but also in the preceding months as we have elevated prices throughout the year. Reducing demand in Asia. So that's the sort of the lay of the land for Asian demand for this year. And I'll go through the different regions and the dynamics in the next 3 slides. So next slide, please. Yeah, usually when we do our market presentations, we start mainly from the big markets like China, Japan, and Korea. But for this time, we'll start from the most affected areas of the world, which is South Asia. Where a lot of the largest adjustment in the demand is we think will likely to occur. And this region includes like Pakistan, Bangladesh, and India. In the left-hand chart, we show you the percentage dependency on the Strait of Hormuz supply, and also the absolute volumes in the dots on the million tons there. So these kind of markets have 3 key characteristics that they share. They have very high dependence on Qatar and the UAE. Pakistan, again, 99% of its imports coming from Qatar. Bangladesh relies on Qatar for about 70%. And more these countries have signed term contracts. So the force majeure, labeled on these countries will have them scrambling into the spot market at very high prices, which will make them very hard for them economically to secure cargoes in this world. So, Bangladesh also, 70%. India is a little bit more diversified, but still sources about half of its LNG imports from the Middle East. Another characteristic that we see here is, again, they're far more price sensitive than Northeast Asia. India, we have an example with the middle chart. Price sensitivity, comparing, LNG has to be competitive against other competing fuels in different sectors. We're starting to see some demand destruction already in the fertilizer sector, and as well as industrial sector. And LNG has to compete, be in the money against the other, fuels such as LPG or naphtha or fuel oil. And so that's something to keep an eye out for, which makes it very difficult, not only on the physical supply side, but the price impact of higher prices make it very uneconomical to import LNG. So again, South Asian buyers operate really under a strict affordability constraint, as well as the LNG storage buffer capacity is relatively limited. Not a lot of data from these countries, quite limited. Maybe a week or two, if not, and particularly in Pakistan, Bangladesh, and India. So we think likely the 2 to 3 week disruption that we're seeing right now in our base case, would be rather more in the demand destruction rather than aggressive spot buying being successful for this part of the world. So Pakistan sharply curtails LNG imports and potentially face power sector load shedding. Bangladesh potentially industrial gas supply cuts, and India to reduce demand modestly, and maybe a 5 to 10% demand destruction and gas demand, particularly in the industrial sector, where power sector demand is not as big in India. So industrial sector would probably take the hit. And again, the higher spot prices will lead to demand destruction. And in the months beyond April, our base case forecast before the Hormuz crisis was, again, $10 spot Asian LNG on average. But now, if we look at a world where Asian spot prices hit $15 for the remainder of the year, or $20 for the remainder of the year, you start to see a regional demand destruction amounting to, you see on the right-hand chart, about 4 million tons for the $15 mark. And then we go higher, even more destruction, around 42 million tons, additional 2 million tons reduction at $20 level. So above $10, it's already quite cost uncompetitive for this region. So you see the demand destruction, not only for this prompt, but continuing throughout the year on very high prices. Yeah, so this is kind of why we think South Asia effectively becomes like the shock absorber for the regional LNG market, based on the crisis that we're seeing now. Next slide. I'll go on to talk about Southeast Asia. In Southeast Asia, these are countries like Singapore, Vietnam, and Thailand. We just mentioned the key countries that import, from Qatar and the UAE, and we think they respond to the LNG market shocks primarily through kind of procurement flexibility rather than immediate like demand destruction that we saw in South Asia. Singapore and Thailand have the highest volumetric exposure to the Strait of Hormuz, but in this scenario, we think spot LNG tenders would likely be delayed or canceled as these buyers wait for greater kind of price clarity and market stability. There's a few tenders out right now, but probably won't be awarded. And structurally, we have some in the middle chart. We just show a historical power generation by fuel type in Thailand, but South Asia, we think Southeast Asia is somewhere between South Asia and Northeast Asia in terms of like flexibility. LNG dependence and power generation is growing, but power systems remain relatively flexible with different types of fuel like coal, oil. In the case of Thailand, we'll probably maximize imported electricity from hydro from neighboring countries. And domestic gas declining, but still playing meaningful roles in the mix. So, for this region, we think the adjustment mechanism is procurement timing adjustment rather than physical demand cut for at least, in our base case that we see the 2 to 3 week outage from the Strait of Hormuz. So we'll see some stepping back from the market temporarily, but tenders will be delayed until prices stabilize. If so, not aggressively looking for replacement cargoes yet. So on the right-hand side, again, we show the bundled selected Southeast Asian country impact at different price scenarios. Base case, again, $10, higher prices for the rest of the year, $15 and $20. you start to see the 2 to 4 million tons of a reduction in this region cumulatively based on the higher prices that we could be seeing from the shock. Next slide, please. Yeah, and lastly, we go to Northeast Asia, and we see, compared to the first two regions, Northeast Asia is structurally more resilient to short-term supply disruptions for now. And this region includes Japan, Korea, and China, which together accounts for over half of the global LNG imports. But their direct exposure to the Hormuz-linked LNG supply is relatively limited. As you can see, Japan is about 6% of its imports from Qatar and UAE, South Korea 14%, China a little bit higher in higher volumes, 30%, and dependency. But its supply portfolio is sort of diversified, across increasing pipeline gas from Russia, Central Asia, domestic production. Shale gas production is rising in China, and they have a portfolio of SPAs, with multiple LNG suppliers. So quite a lot of options there to withhold the shock for the time being. Again, the biggest major difference between the regions is inventory levels. I think there was a question on the chat, but here we show our Japan, Korea inventories as of end of February. These are implied. We model inventory forecasts for Japan, Korea, and China, but Japan and Korea, what happens if the Hormuz affected cargoes do not arrive, and instead Japan and Korea uses inventory stocks. And worst case, for total supply into these countries, there's 2 to 3 weeks or even 4 weeks of supply in the inventories. But if it's just looking at the Hormuz, we can think about like maybe more months level of buffer in these two countries. This doesn't really account for boil off in my analysis, but just for Hormuz level shock, the inventory buffer is much higher, and than the 3 or 4 week number that we see going around. So just wanted to show that there. And of course, the portfolio flexibility, a lot of the Asian legacy contracts, there's downward, upward quantity adjustments. So I'm sure there are discussions around adjusting the scheduling based on existing SPAs from other sellers. And so that's adds to the flexibility that they can do to optimize. So in a 2 to 3 week disruption, very limited immediate demand destruction in Northeast Asia. We're keeping our base case view. But again, some reduction in demand is expected, especially in China. China is one of the most price-sensitive markets with the biggest impact on demand destruction because the volume is so much larger than India, Pakistan, or Bangladesh. So on the right-hand side, we're just showing Chinese LNG demand base case was around 70 million tons, but in a $15 per MMBTU world or a $20 MMBTU world, the $15 jump from the $10 threshold to the 15 already does a lot of the damage, reducing demand by close to 10 million tons for the remainder of the year, and even like about 12 million tons for the $20 level. So this is something we're watching very closely, along with the China's GDP is also a big indicator for demand. If it goes down to 4.5%, you could see some further reduction in demand as well, looking quite bearish for the Chinese side of things. So just the final takeaway for Asia, like different regions, the short disruption that we see, is going to raise prices, and the physical shortages get impacted in South Asia immediately, and Asia sort of rebalances through price signals and regional demand elasticity, as we see here. So, I'll stop there.
Thanks, Go.
And pass over to Ron. Yeah.
Yeah, thanks, mate. That's really good. I mean, again, keep your questions coming in. We've got. I kind of wish I didn't kind of encourage as many because there are about 600 questions on the chat, which is good. We encourage dialogue. That's what we do at Kepler. I'm about to hand over to Ronald. We've got 15 minutes. We will get some questions in as questions coming in around inventory figures on Taiwan, etc. Also, the slides will be sent to you after the session's over. Keep your questions coming in if there's something you want us to go over once again. But we will have a 5-minute Q&A before we bring in the oil side. Just let a headline's just come out on Bloomberg saying the Iranian deputy foreign minister is ready to abandon its nuclear program on condition that the United States presents a satisfactory alternative offer. Headlines galore. You can't take your eyes off them for a moment. Stick with us. We will answer the questions, but I'm going to hand over to Ronald now.
Thank you, Matt, and thank you, Go. So, I guess when it comes to Europe and neighboring countries, like the important takeaway that we have is that even though like these markets are directly less exposed to what's going on like in the Middle East, like they still feel the pain, right? Like they're still seeing prices like skyrocketing, and this is something that we're gonna show to you like in the next few slides. So, basically, when it comes to like understanding the level of direct exposure of European gas markets to imports of Qatar LNG, you can see how in the last few years, actually, imports of Qatari LNG have been reducing in the EU and the UK. Particularly last year, the region only imported 9.2 million tons of these volumes, which represented only 8% of total imports into the continent. So I guess the main question there is like, why if volumes are, not so high, like why are markets like responding, like so aggressively in Europe? And so I guess like part of the reason is because even though like this exposure seems low, it's actually quite heterogeneous. Like when you take a look at the right-hand side chart, so we see that overall, like Italy is by far the market most affected by the potential loss of imports from Qatar. They have like an SPA contract signed with Qatar that amounts to almost like 5 million tons. So they import all these volumes, every year, and it's particularly important now because Italy has become like the rest of Europe, like more reliant on LNG to make for the loss of Russian gas via pipeline, right? So right now, when we assess the situation, what we're seeing is that current Qatari LNG on the water headed to Europe is about like 1.2 million tons. So we expect a lot of these volumes to make it into the European continent in March. Some of that could slip into April. But overall, we are expecting, like Europe as a whole to lose approximately 1.4, sorry, million tons of Qatari's supply between April and May. So this doesn't sound like, it's a lot of volumes. However, like the risks remain, and I'm gonna explain why. So when you take a look at what's happening with prices, you do see that even hot prices that don't directly import gas from Qatar are being affected by these dynamics. And what we see is that this responds to the basically the fact that the European gas market is deeply interconnected. So like if you have a country that is more exposed to this, so like this country will necessarily will have to like import like supply from other places, so enters in competition like within the European continent for the same supply. That's one of the reasons. If we go to the next slide, please. We have other elements that actually contribute to the fact that like European gas prices are quite elevated at the moment. The first one is also that European imports of LNG have increased in the last few years, and as I mentioned before, is because the continent went through a really, like a restructuring of supply configuration to replace, the amount of gas pipeline supply that was lost. Only last year, actually, those imports of LNG represented roughly 50% of total imports into the continent. This means that actually European market players will be exposed to any dynamics taking place in global LNG markets, and particularly right now competing for the same supply coming especially from the Atlantic basin to replace the losses of Qatari LNG supply into the market. So, but there is on top of that another dynamic that is taking place, and it's the fact that at the moment gas storage levels in Europe are at around 30%, so which are the lowest levels we've seen since 2022, which was in the middle of the energy crisis, right? So why is this important? Because basically starting the summer season with low levels means that you're going to have higher restocking needs during the summer. The summer period for us is between April at the end of September. So it means that actually you need all this period, and you need to start early actually to refill all these gas storage facilities that are at very low levels at the moment. If you take a look on the right-hand side the chart, at the bottom, usually when you want to start early injecting, it's quite interesting for Europe, because Asian markets typically enter peak demand in summer and winter. So usually these shoulder seasons, kind of April, May, European gas players actually could inject a lot of volumes into gas storage facilities. But right now, given the current situation and the fact that European market players will face competition for that supply, so the outlook for having access to that supply is at risk at the moment, and that's why European gas prices are reacting to the current dynamics. So basically, what this means is that they will need to fight for the same supply in April and May, but also during the summer, and that's why we are increasing, our prices during the summer period. Of course, a lot of questions to be, answered as to how this conflict will evolve. We're analyzing that quite closely. Next slide, please. Just wanted to have a word on the exposure to Qatar goes beyond just SPAs and supply. Actually, Qatari entities hold capacity at key regasification terminals in Europe, within the European Union at Zeebrugge and Montoir, but also they are the the most important capacity holders in the UK in terminals such as Grain and South Hook. So what this allows is that Qatar actually can profit from this position to optimize portfolio. We've seen them actually very likely reselling some of this slot capacity to other market players. Not only that, we've seen also that Qatar Energy has chartered also LNG volumes into Europe. And what's interesting is that these volumes are not only Qatari, volumes. We've seen also Qatari Energy actually chartering volumes FOB from the US, so particularly from the Plaquemines project. So all these dynamics could change, depending on how the conflict evolves going forward. Just wanted to give some visibility to this because I think it's important. Next slide, please. When it comes to neighboring markets, not only Europe is kind of suffering directly from this. Egypt and Jordan are two of the countries that are affected by the ongoing conflict, not because they import Qatari LNG, but particularly because they import gas from Israel via pipeline. As you know, Israel cut deliveries of this gas on February 28, which basically affects directly these two countries. If we focus on Egypt, what's been happening with Egypt is that they have seen their domestic gas production decline in the last few years, and they started importing gas from Israel to kind of make for that loss of domestic gas supply. But this decline has been so strong that they actually has turned they have become again a net importer of LNG in the last few months. So what that means is that they're extremely reliant to dynamics in the market, and now that Israel actually cut this supplies, which is not the first time this happened. Actually, in June 2025, we saw similar dynamics taking place. However, back then Egypt was way more exposed. Why? Because it had lower regasification capacity in place, and also because June was a period is typically a period of very high demand in Egypt due to high summer temperatures. So at this time, Egypt has announced that actually gas deliveries will not be disrupted to domestic customers. And the answer that we've seen is that they issued a tender for 3 cargoes in March. The tender, our understanding is that it hasn't been awarded yet, but like, yeah, we have, that tender that is for around 0.2 million tons of supply. They also have like in transit LNG accounting for 0.4 million tons. Something that is quite interesting to highlight here is that Egypt is actually right now importing a lot of fuel oil. This is likely to replace the role of gas in the power sector. And as you can see on the right-hand chart, basically a lot of this is coming from Russia at the moment. Like, it's worth mentioning that this is right now in transit. It hasn't completely arrived there, but like, yeah, it's one of the dynamics that we are following quite closely when it comes to Egypt. Next slide, please. And another country that we're following quite closely is Turkey. As you know, Turkey imports gas from Iran via pipeline. We're talking about close to 8 BCM per year. However, these imports tend to be like quite seasonal. We haven't had any confirmation that these deliveries have been disrupted so far. So far, we are not expecting to see Turkey kind of like trying to replace any of these potential losses. But if it did occur, we just wanted to give you some understanding of like, how much that reliance is about. Typically, for the month of March, Turkey doesn't actually import a lot from Iran. And this is mostly because Iran also needs some of that gas like during the winter period. So like in winter, those deliveries tend to be minimal from Iran to Turkey. So usually they ramp up or they increase in April, May, and June. So far, basically, if those deliveries are curtailed in March, the impact for the Turkish balance would be limited. We're expecting it to be, if it happened, of around 0.3 million tons for the month of March. So yeah, just to highlight that. As a whole, I just wanted to say that the takeaway for Europe is that their, the exposure is limited in terms of like the actual volumes that they import from Qatar. But like, given that the region is more exposed to LNG market dynamics and that it needs a lot of LNG to restock European gas storage facilities, that's basically the main risk that is driving European gas prices, very high these days. So with this, I finish. Thank you so much. Oh,
Sorry.
yeah.
Is that your last slide? Sorry, I'm just conscious of time here. Are you done?
That's fine. Just wanted to mention that actually, because of high prices, we are actually expecting to see some levels of demand destruction in Europe, particularly in the industrial sector. So that could amount to like between 1 and 2 BCM in Northwest Europe in the next few months.
Okay. Sorry to cut you off there, mate. What we'll do is more questions. Thanks for the presentations. They're really good. We've got 3 or 4 questions we're going to run through quickly now before we move on to the oil section. The slides will be available after the session is over. So we'll get those to you. Just, speak to your friendly neighborhood Keplerian and we'll sort that out. So let's get around to some questions. There are a few coming in. Some we can answer, some I definitely can't answer. Laura, I'll come to you first. Any disruption to flows from Oman LNG?
Not currently. So there was a vessel that left there last night. There was a bit of a gap between loadings between like the 2nd of March and today. But already we've seen a vessel leave last night and there's already a vessel there trying to load at the moment. Of course, Oman is a risk. We have seen attacks on vessels outside of Oman waters and port infrastructure. So, it is a risk right now. We haven't reduced our supply from Oman at this moment in time.
Because you said to me yesterday, we were talking separately, that's the holding pattern, right, for the vessels is offshore eastern coast of Oman, as opposed to Fujairah anchorage for the tankers, right?
Yeah, we saw, at the start of this conflict, a lot of vessels were in the Gulf of Oman. They've now kind of pushed away from there,
Right.
probably due to insurance reasons. And
Fair.
like I say, that we're monitoring 9 vessels that are potentially moving even further away or to other destinations. So,
Okay. Thanks, Laura. I'll come to you on this one, mate. South Korea has supply of LNG for the next 30 days consumption. Is that a true estimate? And what are the risks if that's true?
Yeah, thank you. I think I covered a bit of that in my presentation,
Yeah.
but 30 days is a reasonable worst case estimate if all LNG imports stop. Basically, not just Hormuz. We estimate Korea has like 3.5 million tons of stocks at the end of February. And imports about 1 million tons, so that gives it a 3 or 4 weeks cover. So again, price spikes and replacement logistics. Korea can really switch to coal generation as well, through policy. So that's going to send some buffer. But yeah, worst case, 30 days.
Okay.
Yeah, is what I would agree with.
Okay, mate. All right. Thanks for that. Laura, I'll come back to you before we close on Ron, and then I'm going to move on to oil. The big one that people have been talking about, 19%, I think, of global LNG supply comes out of Qatar. Ras Lafan's on force majeure. Questions come in. This is the big one. Do you guys have an idea of how much it will take for Ras Lafan, the Qatar liquefaction terminal, I can't even say that, to go from zero to usual capacity? Is it linear or more slowly?
It's not an on and off process. It is something that is probably going to take a couple of weeks. When we get the indication that they're going to restart the plant, which of course depends on whether Strait of Hormuz passage opens up safely, they will start to restart the plant. They will cool down the plant, which has to be a very slow process. They'll then produce first LNG, but in the meantime, they might start exporting from storage. We don't know where the storage levels are
Right.
at the moment, but they could be full. So it's going to probably take 2 weeks. Just one other thing around Qatar. Obviously, there was this drone attack on the facility.
Yeah.
Unconfirmed, but market chatter is there wasn't any major damage to the facility. There was some falling debris, but nothing major. Of course, unconfirmed.
Yeah, sure.
We'll try and get to the bottom of it, but
All right. Thanks, Laura. Look, I just seen
no
a
problem.
headline pop up that there's been a few missiles intercepted over Doha. I hope our Qatari friends are all okay. Ron, let's close with you, mate. Just on the EU. Do you foresee EU sanctions being lifted, loosened, postponed on the Russian LNG imports or other products as well? Just before you answer that, that's something that is not just LNG related. I asked this same question to our insights team earlier in the week, whether it's other products. But go on, give us your answer. What your view is on LNG specifically there.
Yeah, our base case is that these sanctions, this phase out will not be loosed like on the LNG side. So
Right.
basically, right now, Europe still imports a lot of gas via LNG, and actually, we are expecting market players in Europe to maximize, the use of these contracts, while they are, lacking this supply from Qatar. So we're not
Okay.
expecting, any changes there.
Yeah, and it's yeah, we have to be neutral at the best of times. That's certainly a tough question. Look, Laura, go, and Ron, thanks a lot, guys. That was really good. The slide decks will be sent. Ron, I'm sorry to cut you off. Me and my busy thing. There's a lot going on, so I'm sorry to cut you off one slide too early. But if anyone's got any questions, they want to do a deep dive after the webinar with any of the guys, we're all friendly, we promise. But we're going to move on to oil. So thanks, guys. Thanks for your time. Really appreciate
Thank
it.
you.
Thank you.
Ms. Amina Bakr, are you there?
Yes, I am.
How are you?
Yeah, fine. I'm really happy that there are no blasts out today, so it's been quiet.
Right. I mean, if you'd have said that to me 2 weeks ago, I would have thought you should be sectioned. But it is the kind of grim reality that we live in now. Look, the questions that have been, I don't want to use the term firing in, but the questions that we've been talking about all week, everyone's got an opinion. The one thing that the UAE does, and tact isn't part of my vocabulary, but the one thing that the UAE have done is be incredibly patient, right? It seems that there has been across the GCC, there has been a sort of coherent view. People have been talking about what the Saudis do. It seems like the conflict has reached a much wider sort of geographical base, and a lot of people it sort of anticipated. I mean, what's your view there? Does that carry on? Are there specific targets? Is it now moved to an energy issue? I mean, what do you think?
No, I think, Matt, what the world needs to realize is that when a conflict erupts here in this region in particular, it's not a regional conflict. This is a conflict that impacts the entire world. So I think the message is very clear that this is not our war, this is the world's war, and everybody should intervene to find an end to this conflict as soon as possible. Having this conflict drag on for weeks is clearly something that many of the GCC countries don't want to see. A lot of them have been very explicit, including Oman has been the most vocal, saying that we need to return back to negotiations. But it's also a very dangerous path here because if we don't get a full regime change in Iran, that puts the Gulf countries in a interesting situation where you'd had this regime attack them directly. So it's very complicated. I'm not seeing any signs of the Gulf countries getting involved, striking back. We saw Qatar striking back to some extent, but it was more in defense. But I mean, joining the U.S.-Israeli strikes,
Yeah.
this is not something that I see the GCC wants to stay away from that, Matt.
No, you're right, and I've just moved on quick so we can see what's happening on flat price in the markets. Brent is down here. I mean, look, there are lots. I mentioned during the gas session about half an hour ago, there was this headline that popped up on Bloomberg. I mean, when is there not a headline that's popping up, right? And this is that reaction, market reaction to that headline here. So it came in and said, Iranian deputy foreign minister, I'm repeating myself, I know, Iran is ready to abandon its nuclear program on condition that the United States presents a satisfactory alternative offer. I mean, what does that mean?
I think I mean, it's just a matter of buying time at this point. Obviously,
Right.
they're in a position where they feel weakened by what's happening. They still don't have a leader. You have a committee there trying to meet, but they're not coming up with solutions. And I don't think it's actually in anyone's interest to have this conflict drag on. I know that Trump mentioned the 4 to 5 weeks, but I mean, that's already a really extended timeline. I think the only player here, or the only country that's really pushing forward is Israel. I mean, Israel has an interest in what's happening now. They're also bombing Lebanon, attempting
Yeah.
to take land in Lebanon. So it's an opportunity really for Israel, almost the last opportunity to annex more land in this operation.
Frightful, really. I mean, just on while we're on that, surrounding countries, obviously, again, we insert the caveat we can't insert enough that we hope everyone is safe. But countries within the GCC, within the region, their barrels are locked in, right? So Kuwait, Iraq, right? Let's talk about Iraq just quickly because this is something that came in overnight. I've got a lot of very good, close Iraqi friends. The blackout, right? That's what we're hearing. We heard the Basra refinery has a power problem. Realistically, what's your view on how, from a fiscal point of view, it's a disaster, right? How long can this kind of carry on before that situation becomes, I mean, what's the adjective? A desperate situation for say the Iraqi government. I mean,
It is a desperate
where are we now?
situation. We're there, Matt. I
We're
mean,
there.
having the entire country in a total blackout, I would call that or describe that as a desperate situation. They're not getting any gas. They had to shut in around 1.5 million barrels a day of their production. They don't have associated gas. They don't have gas coming in from Iran. So it's a complete shutdown of their power stations. They're in the dark. So I would describe this as a desperate situations. We're seeing kind of the same thing happen. I mean, countries that are locked in. You mentioned Kuwait as well. They're going to have to extensively slow down, cut their production. With Saudi and the UAE, it's a little bit different. They have outlets. I mean, Saudi is utilizing their East-West pipeline. Now
Yeah.
we're seeing more vessels appear in Yanbu. We're seeing a higher utilization and export out of higher than we've ever seen before. I think our latest estimate was something like 2.5 million barrels per day coming out of Yanbu. Same with the UAE. I haven't heard any curtailment of production, and they're using Fujairah basically as the alternative outlet here.
Yeah, look, this is, thanks for providing me with a segue, Amina. It's very nice when you do that for me. But this is the mitigant here. This is what a lot of people are discussing right now. So this is something that our colleague Homayun, he's going to be on in about 21 minutes, talking about crude supply. This is something he wrote, I think it was the beginning of January, 16th of January. We are in this situation now, right? We are in the middle of this situation, and there's no crystal ball here. It was something that I don't think anyone wanted to be proved right. Here's a question for you, though. The East-West pipeline, the capacity you said, 7 million barrels a day, around 35% utilization. It goes from Abqaiq in the east here, excuse my Arabic pronunciation, to Yanbu and the Red Sea. What what is to stop that being a sort of export hub for the region, not just the Saudis? If the Iraqis wanted to put some crude in there, do you think that's something the GCC would get together on, or is that a step too
No,
far?
but why would they do that? I mean, Saudi Arabia's priority is its national interests, right? They are the ones who invested in this pipeline. They're the ones who laid out contingency plans. And we're at a point right now, Matt, where all of the system gets exposed, and we need to
Mm.
show new appreciation for the countries that have contingency plans in place. So the East-West pipeline is the Saudis. They will
Right,
continue using it for their own crude. And from an export side, I mean, yes, the capacity is 7, but you can't. I mean, the terminals in Yanbu can't handle 7. We
right,
estimate something around 5.5 million barrels a day could be handled through Yanbu. The other risk, Matt, is that you have the Houthis in the Red Sea. We
right.
haven't seen the Houthis in action yet, but again, that's a kind of risk we need to flag.
Yeah, I mean, it's like off the flight path, if we ever get the chance to go to London again, is probably via the Cape of Good Hope these days, isn't it? And it's going to take about 22 hours to get from Dubai to London. Anyway, I'm jesting and I shouldn't. The ADNOC terminal, just on the last sort of mitigant out of the Persian Gulf, there's the Murban field here, and it goes across to Fujairah. Issues there though, right? I mean, Fujairah was recently, unfortunately, the subject of an attack. The Fujairah terminal was closed for a while. I think Vopak is still closed in. Obviously, they load the main crude tanks. They're loaded via an SPM, a single point mooring, so the big VLCCs can get in. But that's largely what the mitigant will be for ADNOC, right? What's the capacity there that we think?
I think it's 1.8, but I'll let my colleague Hameyun kind of confirm that. But it has been slow, yes. And Fujairah, there are a number of terminals there, product tanks and so on that have been targeted. But our understanding that the port is still open and they're still loading from there.
Okay. I mean, it depends what time of day and who you ask, whether it's open or closed, and they'll give you a different answer right now. We are living in that kind of ambiguous world. Here's the
But Matt,
big one,
before we
though.
close, yeah, let's talk
Go on.
about prices. And I want to
Right.
get your view as well about the price. Why are
Why?
we, because I'm surprised. Why isn't the price moving higher than what we're seeing now?
Look, it's a good question. And if I've had this question once in the last, even my wife asked me, not even my wife, but when my wife's asking me what the price of oil is doing, there's a problem, right? So look, there's a few things. I put on my chat this morning, and we were speaking about it earlier on. Jet fuel. If we use that as a bellwether with what's happening, and Andon's going to come in a minute to talk about products. Jet fuel in Singapore yesterday was trading at nearly $230 a barrel. That is up 140%, purely because, and our colleague Zamir wrote about it, I think 2 weeks ago, 20% of the world's jet fuel comes out of the Middle East Gulf. Europe simply can't scramble quick enough to get what they need because there's a physical shortage. Here's the kicker, though. If jet fuel had gone up linear with where crude oil, if crude oil, sorry, went up linear compared to how jet fuel has gone, crude would be trading at $175 a barrel. At the moment, at the time of speaking, it's $83.10. Listen, my view, and Homayun has got a much bigger brain than mine and can give you a lot more context, but in my view, being in the market for about 600 years as I have, I think the market is just a bit more grown up than it used to be. I don't think the market reacts off knee-jerk headlines as much as it used to. And I think it's in it for the long term, i.e., it's looking at the whole curve, as far down as you can get, rather than just the front month. But here's the thing I want to ask you to counter that. The longer this goes on, the less the market is able to ignore it. What do you think, just to close up on this session in a minute, what do you think what is that moment? How is it a number of days? Is it an escalation? I don't even want to talk about that. Or is it is Donald Trump and his insurance policy and his US naval escorts going to come to the rescue and everything's going to be fine in a couple of weeks? What is that catalyst?
I mean, during COVID, Matt, what we saw during COVID was a demand shock. What needs to happen to this market is a supply shock. And that didn't sink in yet, despite the huge disruptions in Hormuz, despite major oil producers cutting their production, major facilities in the region shutting down. Somehow, all the big traders, all the big banks out there believe that this is just going to be a couple of days. They're drinking the Kool-Aid. Maybe some of them believe that Trump's plan to escort vessels is going to work, or the messaging out of the U.S. seems to be very, very different from what we're seeing here on the ground in the region. So I think it's just going to take maybe longer time for that message or reality to sink in before we see prices climb up.
Couldn't have said it better myself. Amina, 15 minutes. I haven't managed to offend anyone yet. I've done well. I've been on the call an hour and no one's shouted at me. So it's good. Look, thanks for your time. I know everyone really appreciates it. Let's hope things don't escalate, but we're ready when people need. But Amina Bakr, thanks a lot. Mr. Pavlov, you're in the room, sir.
Of course.
How are you?
Well, a little bit exhausted from everything that's going on, to be honest.
That's certainly the way to describe it. It's pretty exhausting, but it's one of those moments where adrenaline keeps you going. Look, I know you've got some slides to show. Again, anyone's got any questions? This is all about oil products, refined products, what's happening. I just touched on jet fuel there with Amina. I know Andon's going to get into a lot more detail on it. Questions and answers. We'll do a short little session after you're done, so 10 minutes or so. Keep on firing them in. We appreciate everyone. But I'll hand over to you, mate.
If you don't mind, just to elaborate on the previous question about flat price, I think there is a widespread expectation across the market that the alternative of not opening the Strait of Hormuz is just so apocalyptically bad that eventually something will happen, which admittedly has been our base case as to the publication of our monthly expectations for prices and all that. Yeah. Is it going to happen? I mean, every day makes it less and less likely, if you allow me to say. And let me use this as a segue into the opening point I would like to mention to everyone who was kind enough to join us today this morning. And this is basically based on, do you all see my screen? Yes, you should.
Yes.
Basically, based on crude stock availability across Asia, based on for demand cover, based on projections of demand, based on SPR availability, to the best of our knowledge, we will very soon start to see run cuts across various Asian countries. As you can see on the left-hand side, the big demand centers across Asia. We're talking about combined loss of processing capacity in the region of almost 3 million barrels per day in Asia alone. As you can see, most exposed places: South Korea, Thailand, India. Actually, a very interesting case here to be made. The Indian government already made some dances around SOEs and other operators to start thinking about withholding clean product exports, even if they don't necessarily need it in their immediate vicinity, such as what has been the case with MRPL, for example. We do expect that eventually there will be some run cuts also in Jamnagar because of reduced availability of stocks at the refinery. As you can see, even China is not out of the woods yet, and the news from today that China, the government already instructed refiners to start cutting exports, save for bonded sales of jets and fuel out of the country, is extremely worrying, in my opinion. And I don't think the market is really waking up to the realization that for places such as South Korea and India, bear in mind, if China decides to step back from product markets, these are the only two places that can do something about it. And as you can see, South Korea is the highest exposed country across Asia in terms of forward cover, in terms of reliance on flows from the Middle East Gulf. How this is going to play out remains to be seen. Just pointing this out here for everyone to see. As for the Middle Eastern run cuts, I mean, obviously this is also quite sizable across the board, no doubt about it. The projection here is mainly based on how do we see export reliance for these refineries and what we are aware of already in terms of damage, such as Ras Tanura, the Basra refinery, Mina Al Ahmadi having some issues reportedly, Bahrain, and others. What they've said, like if they cannot export, they have to run cut runs. So that is already baked in, and that we do expect that this is going to start materializing in the next couple of weeks. Because I mean, even if the strait is open tomorrow, it's not going to be a walk in the park into bringing this feedstock into where it's needed. So moving on, just for some context across the barrel and across everything that's going on, I know a lot of people are paying a lot of attention to crude. Obviously, this is the most liquid, the market that everyone cares about. But actually, in relative terms, like in terms of exposure of Strait of Hormuz to market output levels, NGLs and naphtha are the highest exposed markets here. And just wanted to leave this here for everyone to just have a visual representation of the reliance of the world as a whole on the Strait of Hormuz traffic for specific NGL and naphtha flows. In particular, here we're talking about LPG, massive exposure, especially when it comes to Asia Pacific, and especially when it comes to places such as India, where we're already seeing the government starting to, I would say, mildly panic about availability of LPG for a domestic market. On the flip side, also, a lot of naphtha comes out of the region. And as you can see, if we go into the next one, while the situation already hasn't been rosy for steam cracking operators across Asia, it's now an absolute disaster. And we're already seeing rumors and indications that steam cracking operators across Asia as a whole, as a blanket decision, will be introducing some utilization rate run cuts, in terms of operations. Obviously, it makes perfect sense right now. It's difficult to find the feedstock. It's difficult to project about for demand for output of petrochemical plants. It's also difficult to compete with anyone, really. As you can see, just one thing to leave everyone with from this side of the angle is that ethane stands to gain the most in this environment. Ethane is out of the woods from any kind of disruption here. So if there was anything that would probably happen now, is that whoever has access or whoever has the capability to process ethane will be increasing utilization rates in the next couple of weeks, because it just makes sense right now. Everyone else is very much locked into this problem, which brings us to the next problem. A lot of people are thinking, well, gasoline, maybe not so much exposure because it's a smaller share and so on and so forth. Sure. However, don't forget one thing. We are yet to see how this is going to pan out in terms of octane blending components, particularly when it comes to the European market, but not just the European market. Because if we have a problem with naphtha supply, we will eventually have a problem with octane blending components. And if we have a problem with that, we have a problem with the availability of on-spec gasoline. And we are just about to start the summer demand trading, and that could also spill over into the gasoline market. It will eventually spill over into the gasoline market, is all I'm saying here. In terms of the outright exposure, again, not as much as like you would expect, especially when you compare this to middle distillates. As you say, jet cracks basically skyrocketing to insane levels right now, especially in Asia. In terms of outright gasoline exposure, not so much of a problem. However, if China decides to stay away from that, and bear in mind, because of everything that's been going on, for the first time in a couple of months, export incentives out of China for gasoline actually turned positive from the beginning of this week. Now with the new instruction from the government, it basically means the Chinese refiners will be shying away from gasoline exports. And as you can see, if you take this out and if you couple everything together in terms of like demand dynamics and supply availability and run cuts, you get into a situation where the Asian gasoline's balance starts to look pretty scary in this environment. And like there is really no easy solution for that. I would say if you were thinking about who could benefit from all this and who could benefit from everything that's going on, I would be thinking European refiners, US refiners, basically everyone who can and is geographically less exposed to supply from the Middle East Gulf, plus the new refineries in Nigeria, Dangote and Dos Bocas, which probably, like, if you allow me to say this is probably the time of their lives, the time to shine, because there would hardly be a better opportunity for these refineries to start really ramping up operational rates. And indeed, we have recently seen Dangote ramping up run rates quite significantly for over the past couple of days, which we believe also has to do with some successful secondary unit operations. We have been talking about this recently, so we can share more material about this. But just going back to the exposure and what's going on here, gaso diesel, as you can see, massive exposure. East-west swaps basically like going to insane levels that currently I think like they just no longer matter in terms of actual physical movement, because like these spreads, like these relationships are built for normal times. As you can see, every chart needs to be adjusted at this point in time. In Northwest European gasoil imports, exposure here is almost 12% as of February. What this also means is we would be getting in a situation where the European market, because we had this in the questions earlier today, the European market and the EU as a whole will have increasingly hard time to defend very strict reading of very strict interpretation of the 3MA point in the 18th sanction package, which is about processing of Russian crude. Case in point here is that we've already seen some Jamnagar cargoes clearing both in the Mediterranean, in Northwest Europe. In Northwest Europe, even the cargo managed to then further, the barrels managed to then further get discharged into other ports across the area. So expectation is that the strictness of implementation here is going to be scaled down, at least in the near term. In terms of like what is happening across the Atlantic basin, and like of course it's not just this, it's also Ukrainian drone attacks, it's also lack of Russian exports, it's also lack of Russian crude processing or lower crude processing. As you can see, Brazil, PAD 1 will be competing increasingly more for these increasingly scarce gasoil barrels into the next couple of weeks. Unless there is a resolution, this is basically a recipe for a summer of incredibly high cracks. Basically, this environment is sticking around for the foreseeable future. The Mediterranean slightly less exposed than that. They have more options. They also have the availability to tap into the into more Middle Eastern crude that's being piped from the east into the west. However, it's also a non-negligible export exposure here. It also moves in tandem with everything else. But it's worth highlighting that even in the Mediterranean market, you will be having problems into securing supply. This also hinges on the availability of Russian product, which is increasingly more and more difficult to justify. As for, as I said, the EU sanction implementation, incredibly difficult to highlight. Just wanted to highlight this one point, that the La Rochelle discharge from Jamnagar has managed to find its way also into other ports, and it's already visible in the data. We've published a couple of updates about this point, so I encourage everyone to maybe go and take a look at this. I think this is a big part of the answer as to how strict the European Union is going to be in implementing the sanctions on Russian-derived products. And the answer is probably not very strict. Also, this becomes increasingly more convincing if you look into the barrels at risk for gasoil into European market, combined with everything that's traversing the Strait of Hormuz. So, basically, one point to highlight here is that if Europe shies away from these barrels and decides to stay away from it, which is increasingly unlikely, but let's assume for the sake of the argument it does, then there will be a really easy solution for that. As we've been seeing, the US is more than willing to absorb these barrels from India and Turkey in this very near term. As for China, now the new decision to cut March exports means that basically everything goes out of whack into the Singapore market. If there were some hopes that China is going to step in and fill the gap, I think those can be thrown out of the window right now. So if China shies away from the market, as you can see, even into the Asian gasoil balance, that is way less, I would say, tight, or it's less dynamic than the west of Suez one. If you take China away from that equation, things are starting to look pretty dire into the near term, even barring everything else, right? Like this is assuming things return back to normal into the near term, because I'd say we basically don't dare to start modeling into an environment where this conflict prolongs for more than 2-3 weeks. into the future. Just final point about the jet situation. As you can see, flows at risk into EU27 right now plus UK is almost 80%. This is insane level into this environment. As I said, like this is like sticking to strict rules is no longer a luxury that the EU and UK can afford. Or if they decide to do so, then the new crack levels of 100 whatever is the new normal, and we'll just have to live with that. As you can see, the global regret spreads right now tell you like try to dump everything you can into the jet pool. There are limitations to that. This was another great question from the Q&A session. We could be talking about 2 to 3 percentage points shift from the gasoil into the jet kero pool, because otherwise you'll start facing problems into various specifications for jet. Also, if China stays away from export markets, i.e. Chinese jet material going into Singapore and further afield all the way into Northwest Europe, this also means Northwest Europe will basically have only one option to turn to, and this would be the US. Even if the US were to decide to do that, which it can't because of having its own regional disbalances into this market, there are strict pipeline and export terminal limitations, as well as specification differences between the two markets. So even if in a scenario where the biggest optimists in this world turn out correct and we start seeing more and more jet flying out of the US, which is extremely unlikely, this also won't really help solve big part of the problem for European jet supply coming into the next couple of weeks. So just in a nutshell, for everyone on the webinar, pay attention to jet markets. As Matt said, that is probably one of the most fragile parts of the barrel right now. Don't forget about naphtha and the relationship it has with gasoline production and gasoline as we move into the summer season. And of course, middle distillates will be remaining elevated for the foreseeable future, simply because you cannot easily phase out the risk premium that we're currently seeing. If the last year's war teaches us anything, it's that even if things go back to normal, I mean, let's assume this crazy spike here goes back to more normal levels. This doesn't mean that we'll go back to the levels that we saw, for example, already in December or January of this year. So on that note, thank you very much. And
thanks, Andy.
Yes.
Thanks, mate. So basically, keep your eye on everything. Is that what you're saying? Yeah.
Yes, but in order of importance, I would say, in order of exposure here.
I know. Look, we've got some questions that are coming in. We will have some time after. We've got Homian to come on now about crude. Got a few slides there. Any questions that people have got, let us know. There's loads on the chat. We will have time. Amina will join us as well and run through some questions. Slide decks and recordings of the presentations will be available after we've finished. So we'll let you know. Homa, I'll let you take over, mate.
You're still on mute, Homa.
Still on mute, mate.
Yeah. I'm Matt. Just checking you can hear me okay?
Yes, sir.
And that you can see the slides correctly as well. They're working?
Not yet.
Yes. It's not full screen.
Yeah. Should be now.
Yes, sir.
Yeah. All right.
Yeah. Gotcha. Thanks.
Great. So there's not much time left, so I'll try to go as fast as possible. Just before I start, I would actually say, on the back of Amina's comment, where I think you said that it doesn't benefit anyone for this war to continue. I think it does actually. I think most people in Iran want this war to continue because reportedly the strikes are mainly hitting the sites which were used for the crackdown. Obviously, they're hitting the nuclear and ballistic missiles launchers too. But I think the Iranians would want this war to continue. And it's actually something that in the long run, or in a few weeks or months, could help them overthrow the regime. So with this having been said, looking at the situation right now around the traffic, so obviously it's not something new anymore. We've seen a huge reduction in the traffic, both entering and exiting the Gulf. So in terms of the number of vessels entering and exiting, it's been really, really low. We've seen some vessels continue to do so. At the beginning of the weekend, it was mainly Iranian and Chinese tankers. But even this has actually come down, even though we still see here and there, one, two tankers entering and leaving every day. So just very fast, you mentioned already, Matt, the two main pipelines that bypass the strait. So just a reminder, we have the East-West pipe in Saudi Arabia that has a capacity of 7 million barrels per day. Before the war, being used at around a third of that capacity. Now, that third capacity is also feeding refineries on the west coast of Saudi Arabia. So not all that 7 million barrels per day can be exported. And as Amina correctly said, the loading capacity is also a bit more limited. We have it around 5.5 million barrels per day from Yanbu. ADNOC has the ADCOP pipeline. Typically capacity is 1.5, but they have the ability with the addition of chemicals to temporarily increase that to 1.8. And before the war, it was being used at around the rate of 1.1 million barrels per day. So what this means in terms of the flows and how much could continue to reach markets, provided the Red Sea and the Bab el-Mandeb stays relatively safe. So we're talking about 8 million barrels per day that are more or less at risk, and that's out of a total of roughly 16 million barrels per day that used to be exported from the Persian Gulf in January, February of this year so far. And so you have the chart on the right shows you how much can be exported from where. So we have made the assumption that obviously with the RRGC making the threats of hitting vessels with missiles, most likely the Iranian barrels could continue being exported, even though that number can come down because you still have a lot of Chinese vessels that come and pick Iranian barrels. But nonetheless, so the key here is really to look at Saudi and the UAE, which would be the only two countries being able to continue export their crude. Iraq exports crude from the north. It takes mainly crude from the Kurdistan region, but there is no infrastructure to bring production from the south, which is around 85-90% of the country's production. So there is no infrastructure to bring the crude to the north. The best they could do is maybe truck some of that production, but at the best scenario, you could only truck 40 kbd, so it won't be much. So Iraq is actually in the weakest spot in the region, mainly because of its limited storage capacity. And so on the left chart, you can see the onshore storage that we estimate, using satellite imagery, looking at floating roof tanks onshore. And you can also see the unfilled storage capacity that's left. So we've assumed, on the left chart that you can fill all these tanks at an average rate of around 90%. And so using that, unfilled storage space, we estimate that these countries could continue produce at current levels until they reach that 90% filling rate at the storage capacity. And if you look at Iraq, we estimate the storage exhaustion would have been reached in just 3 days. So that's why Iraq actually 2 days ago already announced that they are reducing production from Rumaila and West Kurna too. So these are the two largest fields in the south of the country. And together they have production capacity of 1.7 million barrels per day. And we think that production has reduced by roughly 1.4, 1.5 million barrels per day so far. The other countries in the region, as you can see, Saudi, UAE, Qatar, we think they can continue produce at current rates for roughly 20 days until they have to implement production cuts. This obviously doesn't take into account the potential for run cuts, as Andon mentioned. If you have run cuts, then that number of days actually comes even more down. On the other side, the number of ballast vessels entering or currently in the Persian Gulf has really decreased. So it used to be around 60, 65, and it's now just above 30. So you still have roughly 30 vessels, most of them VLCCs, that could be used as storage in the short term. So that number of days could be slightly higher because of that. So as we mentioned, as Amina mentioned, we're starting to see more shipments from the Saudi West Coast, and our data is already supporting that. You see that the level of shipments is really on the up so far in March. Part of that, though, is used to feed the Jizan 400 kbd refinery, which is in the south of the West Coast. And so that's fed by seaborne shipments. In the UAE as well, we've seen an increase so far month on month, even though we haven't seen any loadings take place over the past 2 days, with Fujairah being hit 2 days ago. So depending on when Fujairah opens again, we could see that volume slightly come down. And lastly, we've heard that northern Iraqi production has been reduced, mainly because the RGC has been targeting some of the bases and some areas close to the fields in the north. But reportedly this morning, some of the fields have reopened. But nonetheless, so far we see a decrease from exports from the port of Ceyhan in Turkey, as well of northern Iraqi crude. Now, a quick note to say, one of the questions that you guys raised, Matt and Amina, was why don't we have prices reacting a much stronger way so far? I think one of the reasons is the fact that you have still a lot of oil underwater. And just waiting to be basically discharged. And so, total volumes of oil in floating storage. So we define floating storage here as a minimum of 7 days for a vessel being idled. And so that's roughly around 110 million barrels so far. Obviously, most of that consisting of sanctioned crude, so not everyone can buy that crude, but so you mainly have Iranian and Russian oil in that floating storage. Another reason why prices haven't been reacting in a much stronger way so far is the level of onshore storage, particularly in China, which is at an all-time high so far. So it could mean that in the short term, some of these Chinese refiners make use of that storage rather than go to the physical market where prices have skyrocketed, and you already have some prices close to $100 per barrel on a delivered basis into China right now. So that's what I was mentioning. You see prices in the physical market really skyrocketing. So far, I would say that one of the key beneficiaries of what's happening is Russia, because its discount has actually been obviously coming down over the past few days. Iran's discount too, because you have a lot of oil from Iran, as I said, available in the Asia Pacific, and you see on the right the volume of oil underwater in the Asia Pacific. So this is crude out of the Persian Gulf, very, very high and close to its highest over the past 5-6 years. The other key question is whether other refiners, the ones that do not buy that sanctioned crude, go for unsanctioned crude, and obviously one of the key sources could come from the west of Suez. And we've actually seen so far over the past few months a reduction in the flows coming from the west. That's mainly on the back of a wider Brent Dubai spread. And when I say wide, I mean you look at the right chart, what was considered as being wide. You can see this on the left chart. So roughly $1.7 per barrel. Obviously now it's considered not so wide because the Brent Dubai spread has gone just crazy, and that actually makes it very problematic for the Asian refiners, because if they buy crude from the west of Suez, it becomes very, very expensive. But obviously, if they don't have the choice and Middle Eastern exports are limited, then they would need to resolve to that option. Quick word to say that Iran still has options to hit other installations in the region. So far, I would say that the small hits that we've seen at Ras Tanura, in Bahrain, in the UAE, mainly are a warning signal to the neighbors that we can hit you hard if we want. And that's been done so that these countries in the region push, as Amina said, are trying to push the US to stop the war as soon as possible. So this appears to be the strategy from Iran. But I think it's a risky one because, you've had Qatar reply launching a missile on the Iranian territory too. So you could have these countries in the region officially join the coalition if they feel that it's really an existential threat to them as well. I would add that one key other type of installations that could get hit is the desalination plants, water plants in the region. If Iran hits that, I mean, it's obviously very easy targets. Then it becomes something much more dramatic, even more than the global energy supply crunch that we are currently seeing. And I would simply finish on saying that the base case view that we have so far is that this is not a war that can last very long, mainly because it has huge implications for the global energy market. Iran knows that. It's the only leverage they have, so they're playing on this. But it's only day 5 of the war, and the US, Israel are hitting the missile launchers very hard from Iran. So I think it's really down to how fast they can reduce Iran's ability to launch its missiles around the world, around the region, and around the Strait of Hormuz. Once there is more clarity that this is the case, I think we will gradually see a resumption of the flows around the Strait of Hormuz, and therefore the risk premium will start coming down. So you see our price forecast on the right. This is North Sea dated. We do think that most of the risk premium is going to be staying over the next 2 weeks before we see that starting to fade towards late March and beginning of April. And I would just finish saying that it seems that from a military equipment basis, some of the aircraft carriers from the US have to go back to the US, like the Abraham Lincoln can stay only until the end of April. So the US has that 4 to 6 week window to finish that war, I would say. And it's also why we don't think that it's a war that could last a lot longer time. And last point is to say that everything that's happening now, in the end, will end up being bearish. Whether there's a deal between the US and Iran, whether there's regime change in a form or another. And even right now, you already have producers in the US hedging their operations for the next 6 to 12 months. We've published an update on that on Tuesday. And so it means that our new view for US production is 200 KBD higher than what we used to have a week ago by the end of the year. So by the end of the year, we should have more supply. Potentially, you will have other refiners buy Asian crude, Iranian crude, not just the Chinese. And that means that by the end of the year, we should be a bit lower in terms of prices. And that's
Thanks,
everything I had tried to go as
Thanks,
fast as
mate.
possible.
No, look, I mean, you said it's only day 5 of the conflict. It feels like day 5005, to be honest. So, yeah, look, it's a tense situation for any. Let's get some questions in. I know we're out of time, more or less. Tom, I want to start with you on this one. This is a good one. Would the US Navy start to seize Iranian oil cargoes as this progresses? So, if we're talking about what happened with Venezuela, where we saw the US Navy board Venezuelan boats, sanctioned oil. Do we get to that point in Iran?
I think it's a possibility. I don't think it makes sense for the US to do it right now because even if they do it, it means less oil available. Even though it's only to the Chinese teapot, it's nonetheless less oil available, and that could push pressure upwards to prices. But I think yes, it's a possibility that they try to hit Iran that way. I would say that it doesn't bring a lot of things to the US because Iran's oil that is being exported right now, even when it discharges, Iran manages to get the money from it 2, 3 months later. So it wouldn't impact Iran's revenues right now. So I don't think it makes a lot of sense, but it's something that it remains very possible.
Okay. All right. Thanks, mate. I'm going to bring in Amina back as well, but I just want to touch on a question that came in that I think with Andon, just quick for a minute, we'll close up with Amina. This is something that is a question that I think will be reverberate across all markets, right? And it's essentially down to the EU. But what's our view, the house view? I did ask Ronald this about LNG. The longer this carries on, and the more Europe specifically are seeing a shortage of oil products, whether that's diesel, gasoline, whatever it may be. Do the EU relax sanctions rules on Russia? Is there a way that there is a conduit that's set up, bearing in mind how long things take in the EU? I'm Brexit, by the way. Bearing in mind how long things take in the EU to get set up. Do you think that there will be some kind of conduit to bring Russian energy back into Europe? Bearing in mind, before Russia invaded Ukraine 4 years ago, I can't believe it's gone that fast, 49% of Europe's diesel used to come from Russia. Is there a way, I don't want to say a way back because that's totally wrong, but these are extenuating circumstances. Do you think that there's a chance that Europe do that?
Yes, I think if prior to the war in the Middle East, chances were closer to 1%. Now I would say they're hovering around the 30% mark, in my opinion.
Really?
Still less than 50. I don't think it's more likely to happen than not. But if this prolongs for more than a couple of weeks, I would not be surprised to see a gradual return, at least in some shape or form.
And do you
Bear in
think
mind,
do you think Russia will just do you think Putin will that he'll just come in and say, yeah, sure, I'll help you?
I mean, at the end of the day, it doesn't really matter. Like the vessels are going to move. Like I've been seeing your Russian LNG clearing into European ports for the past 4 years, regardless of all the rhetoric and all that. So yeah, I don't think it's impossible to see it anymore. Just wanted to highlight one thing. This is a great question also for other points. If you think about like where Russian crude stands right now and where it is, I would encourage people to look into India, because this is, in my opinion, the most susceptible place to return, at least a gradual return of Russian crude into processing, at least in the near term, before the situation starts to go back to normal.
What do you mean? Is West Coast India become the refining hub for Europe, for European product demand?
As in, the scale back of Russian crude buying from Indian refiners could also be scaled up again soon. That's what I'm saying. Because there is a physical availability there, so there's also the incentive to do that.
Okay. Wow.
And also bear in mind that the US government indefinitely exempted the Shvet refinery yesterday from sanctions on processing crude. So there's something also in that.
No, I mean that's probably another whole webinar we can talk on there, Pavlov. So we'll do that. But thanks, Matt. Appreciate that. We'll close up with Amina. Final comments. Amina, hi. You're back.
Hi, Matt.
Hi. It can't be a crude conversation or an energy conversation without talking about OPEC. They've been remarkably quiet, as a group have been for the last few years, been remarkably stable. And we've had a questioning. And I'm going to put you on the spot because you're in the room. What is your expectation on OPEC's deal and its compliance in this situation? Do you see them making a decision next month to mitigate what is going on? How are things within the group in your view? I mean, how are they looking at all of this?
Well, during the last meeting, I saw them quite, again, in these extraordinary circumstances, stand quite united. I mean, there were media headlines, Matt. We all read that, the group is going to unwind by 400 or 500,000 barrels a day to make up for lost supply. But why would they do that when they're dealing with limited spare capacity? They need to manage that spare capacity very, very carefully. And in terms of compliance, I think there's a lot of accidental compliance because of the circumstances, having Iraq cut 1.5 million barrels a day. So we're going to see a lot of extra compliance. But on the other end, I mean, if we were talking about overproduction before, this is going to be a major underproduction. Where do I see their policy kind of looking forward? It depends where we are in the conflict. If this conflict ends, but just generally speaking, I find them still taking kind of cautious steps towards unwinding these voluntary cuts. How much of that will depend on the length of this conflict. But overall, Matt, there is no single supplier or just even outside of OPEC that could make up for a loss of 20 million barrels of flows through Hormuz. We just don't have that spare capacity in the system. And I think that's something that needs to sink in the market. And perhaps it'll just take longer for them to realize that.
Drill, baby, drill.
Drill, baby, drill. Yeah.
Saw
Humayun saying about US production going up. So yeah, it's definitely drill, baby, drill.
Okay. Look, cautious steps. You heard it. Look, thanks, guys. The gas guys, Ronald, Laura, go. Amina on the crude oil side, of course. Humayun and Andon on the products. Have we reached conclusions? I mean, look, we've tried to give clarity. It's so ambiguous what's happening in markets. If we can offer you any navigable fields and ways to look at the market, we try and do that at Kepler. Of course, this won't be the last webinar for a while. I'll probably see you in about an hour, everyone. But thanks to everyone who's joined. Thanks for all the presentations. They will all be available. Recordings will be available too. Take care, everyone, and we'll see you soon. Cheers.